Our next guest says the bulls will win this September standoff. JP Morgan's chief global market strategist, Marco Kolonovich, just upped his year-end S&P price target to 4,700. Marco joins us on the fast line. Marco, great to have you with us.
Thank you, Melissa.
I mean, you think that it's the reopening trade, it's energy, it's all these things that will power the S&P 500 higher. What is the backdrop to this bullish view?
So the backdrop is basically a decline in coronavirus globally. So if you look at the August 30th, cases started declining globally. So that's already for 2 weeks they're declining. We are seeing mobility indices picking up. In the U.S., a little bit slower, but still actually declining about the last 7 to 10 days. We now have around 35 out of 50 states cases are declining. So basically, declining coronavirus, which we thought was the main driver, COVID Delta was the main driver of slowdown that we saw in July and August. So it basically hit the consumer, hit the travel sentiment, and basically you had this big rotation out of cyclicals and into sort of defensives and growth. So we think now that's going to go in reverse, and basically it's going to sort of provide some support for the market.
So Marco, you have a price target for the S&P, I believe, at 4,700. If you see that rotation into cyclicals, how do you see the market playing out? Can the market move higher if cyclicals take over the leadership?
So that's a good question, and that's where we debate a lot and discuss a lot. So we think ultimately yes, because basically we see this as a very early stage of economic recovery. So if you look at the consumer, consumer is pretty healthy. If you look at the inventory cycle, if you look at the capex cycle, if you look at the just sort of reopening of economy, we still, half come to office, little international travel, little business travel. So a lot of these things we think are going to now kick into higher gear with decline on COVID. So we think in that environment, sort of everything can go higher. That said, we think cyclicals will lead, and growth and tech and highly valued segments will feel a little bit of a headwind. So now that headwind is going to be function of the yields. How far yields go. We think yields go higher, and market goes higher, but we think it's going to be led by cheaper cyclical value segments, and sort of growth segments. Have to inch higher, because if we assume if our target is market goes higher, then we also think that the tech also goes higher, but much less, and then some of the parts of the growth segments, the hyper growth, may actually go down. But overall, we think market can inch higher. Look, and 4,700 is not very far out of here. We are basically 4,500, so we're looking at here 5-6%. We're not calling some crazy bull market, but we think everything can go up, led by cyclical. So that will be financials, materials, energy, industrials, consumer plays and stuff like that.
Hey, Marco, it's Tim. Part of your work that's been so effective in the last couple of years has been equity positioning from institutions and where they are. Seems to me equities are heavy over. Well, they're certainly well positioned in equities. They're not terribly well positioned in terms of their downside protection in the market. Does that concern you? And again, in terms of rotation, you seem to be pretty excited about emerging and global markets, maybe more so than U.S.
That's correct. So let me first on a positioning. So on a positioning, we always differentiate between discretionary managers and systematic manager. So systematic funds. So systematic funds are about 70-75 percentile historical. So they're above average. But we see actually discretionary manager about average. So a lot of people are having this view, kind of, well, correction is overdue. Let's put some chips off of the table, and they're doing that. They're doing that by buying options. Some of them actually scale a little bit back. Some of them are more playing market neutral. So we actually don't think that positioning on a discretionary side is high. It's about average. On a systematic is a little bit higher. But that doesn't mean that it has to go lower unless we have some very negative catalyst. On the international versus domestic, emerging versus developed, basically our view on COVID recovery projects onto sectors and styles. Value, cyclicals, growth, defensives. When you project these factors on different international markets, EMs, emerging markets, are more heavy in value. They're more heavy in cyclicals. Even Japan and Europe are more sort of heavily weighted in these segments. So we basically expect more upside in these as compared to S&P, which is pretty heavy on the NASDAQ and on FANGs and the growth type things, which we think will do okay, but not as good as cyclicals.
Marco, I'm wondering, the backdrop you said was declining COVID, declining Delta. There are flare-ups around the world, and differences in vaccination rates around the world and the different kinds of vaccines used in terms of efficacy vary greatly as well. And so I'm wondering, at what point do you start getting concerned at say, for instance, the flare-up that we're seeing right now in southern China having a ripple impact on the rest of the world or that region?
So that would be a risk, like the Western Europe and United States, pretty high vaccination rates, pretty high natural immunity from actually a lot of people having a COVID already or had the COVID already. So China didn't have as much COVID, so that's a little bit of a risk. So certainly we're going to watch these things carefully. Keep in mind, weakness in China in July and August, which we saw in mobility data in China. We saw some of these ports closures and stuff like that. So it's sort of already played out a little bit, but certainly that would be the negative development if there would be like a big outbreak in China. So I would put it in one of the risks to our thesis, but it's not the main case. Even in China, vaccination rates are pretty high, and then, as you mentioned, we need to sort of look at a different type of vaccines, which probably goes beyond our expertise.
Right. Last question that I have for you tonight, Marco, is what does the other side of up 5 to 6% through the end of the year look like? What does next year look like?
So next year, we just actually today put out the 5,000. So it's not a sort of a formal year-end target. We said it's going to be sort of reached and probably beyond 5,000. Very little visibility right now exactly when. If the things go very well, sort of with the COVID and reopening, I think 5,000 can be early in the next year. If we do have a hiccups, whether it's related to Fed, whether it's related to some new variant or something out of the left field, it probably might be a little bit more towards the end of the next year. But we did put a 5,000 today for the next year, a little bit vaguely when exactly next year.
All right. Marco, great to speak with you as always. Thank you.
Thank you so much.
Marco Kolanovic, J.P. Morgan. Guy Adami, what's your take?
I happen to agree. I mean, cyclicals, financials, resources, right? I'm with him on that. And, I think it's going to happen because rates are going to go higher. But if rates go meaningfully higher, I think we're going to lose a lot of these high growth, high valuation names, and I don't think the cyclicals, resources, and energy can hold up the S&P 500. So I'm with him right up until the S&P 500, 4,700 call. So again, I agree with him on those sectors. I don't necessarily agree on the S&P.
Karen, in your portfolio, are you worried about any names getting swept up in a rotation if favor falls on cyclicals? And growth names, pro-growth, I should say, not growth names per se, then what happens to some other stocks in your portfolio?
Well, I'm praying for a rotation, actually, to some of them, like, for example, like a FedEx, which really has traded very poorly. It's been very out of favor. The banks, which have traded nicely, but, well off, somewhat off of their highs. So I think they will continue to do better in that rotation environment. When we talk about the market, we think of it as this monolith. There could be places to make money where other places are definitely not the way to make money. So I agree with Guy that the real high flyers, that's probably not going to be the place to be. So I got this kind of barbell, but I have some industrials. United Rentals, I think, will do better. So sure. I hope that happens.
But you got in your portfolio, and many of you, like Tim, for instance, you have an Alphabet in your portfolio, which is not necessarily a high-flying, high-valuation name, but it's in these baskets with high-flying, high-valuation names, and when caught in a rotation, are you worried that just gets thrown out with the rest of them?
Well, I think Alphabet can be more defensive, and I actually think that Amazon may be breaking out. I know Mark Mahaney threw a $4,700 target on it, and I think there's still some room for some of those names. So, but I do believe that the cyclical reflation, type names that we're talking about, we're calling them value names at times, look interesting. For example, I think the auto market, and my view on autos, I'm bullish, but I think like even EU autos, if you look at these charts and if you look at the cyclicality and how these economies are opening up and where you're getting actually earnings revisions to the upside, there are a lot of sectors like that. And so Guy's point is one of doing the math. He's right. We all know where the passive money flows and the weightings in these indices are, and where obviously you can be in a kind of a difficult period for growth and the market moves higher. And I think what we're all pointing is that we're relatively constructive on the reopening here. How this plays out in terms of the numbers in the stock market, I think you're going to get a little bit of both again with a heavier weight towards some of this cyclical.